Okay, we have a special treat now in an interview with Arthur Kroeber. I think those of you who know China well know how highly he's regarded. I've heard him speak before, and not only is he knowledgeable about the economic situation in China, but he has a very insightful look into the political situation as well. So we're going to start off with some questions about the macroeconomic picture and then turn to microeconomic issues inside China itself. So Arthur, my first question is about how you see the global macro scene. What do you see for growth rates in Europe, Japan, US, and then get to China, and we'll turn into China questions after that.
Well, the global picture is, I think, quite a bit more uncertain than it was a month ago. A month ago, we seemed, I think, fairly comfortably settled into a kind of a secular stagnation scenario where the U.S. was likely to bump along at, something over 2%, at least for another year. Europe was recovering a little bit, but was still stuck with a growth rate that would struggle to get up much above 1%, but basically because of the enduring problems in the financial system that they have not yet resolved. And Japan similarly was kind of stuck. Obviously, what's changed in that equation is that we had an unexpected result in the U.S. election, and it's not 100% clear what Trump is actually going to do because he's made a lot of contradictory statements. But certainly the markets have taken the view that the new administration aided by the Republican Congress is going to be essentially pretty inflationary, and that there will be a lot of new spending on things like infrastructure and so forth. And the only question I think that comes out from that is if the market is right that we're going to see a significant increase in nominal GDP growth in the U.S. by a couple of percentage points, is that going to come from actual real GDP growth, i.e. productivity, or is that simply going to be inflationary? And we don't know the answer to that question. I think the problem in analyzing the growth outlook for the world right now is that really we do not know what is going to happen in the U.S. It's become a real wild card. Depending on how things play out, it could be pretty good for the rest of the world or pretty bad for the rest of the world. So just a couple of observations. One is, if we have a kind of a repeat of the early 1980s, early Reagan era type of extremely expansionary fiscal policy that leads to a huge continued increase in the U.S. dollar, then that's actually pretty negative, I think, for a lot of emerging markets particularly, which are in general negatively correlated with the strength of the U.S. dollar. Similarly, if you have a move towards protectionism and an effort to reshore U.S. production and kind of dial back the agenda that we've had for the last 35 years of globalization and freer flows of trade and investment, I think that generally is a fairly negative outlook for the rest of the world. On the other hand, you could imagine a situation where basically the protectionism doesn't come through and you just run a very expansionary policy in the U.S., which ultimately feeds through into higher wages and consumption activity, and that is broadly beneficial for the rest of the world. So a little bit hard to say.
Okay. Let's turn now to China itself. I thought in this morning's panel, when Long Mei put up her table about why the different forecasters had gotten different estimates, I thought it was quite interesting because she was essentially arguing that they had chosen different reference groups, either East Asia, all developing countries, or had some particularistic information about China that led them to believe that China was going to grow at a different rate. Do you want to try to organize that information on your own terms and give us your forecast, at least for the next, say, 1 to 2 years?
Yeah, well, I usually tell my clients that I don't do forecasts as a matter of principle, because the one thing about forecasts is they're always wrong. However, people do like a forward-looking view, and so I can describe that. So among the categories that you just described, I'm sort of fall between category 1 and category 2. Typically, when we do comparative work, we think that the most relevant comparisons for China are basically the rest of East Asia, Japan, South Korea, and Taiwan, because they've had the same growth model. And conversely, comparisons to places like Latin American countries are not very useful because both the growth model and the nature of the social structure are completely different. So yeah, I think there is a little bit of a problem in comparing the Chinese growth trajectory with some, unweighted average of the experience of all emerging markets. Generally speaking, my view of Chinese growth would be, sort of skewed, potential growth would be skewed a little bit towards the high end. A couple of caveats to that, though. One is, as it was pointed out in the previous panel, if you look at the demographic structure of China today, it is much more like the demographic structure of the East Asian countries when they were already at a significantly higher level of income. So if China had the same demographics and the same income levels as South Korea and Taiwan, particularly at an earlier stage, then you could say, oh, well, these growth trajectories should line up. But China has a much worse demographic profile, and so all things being equal, I do think that that is negative for growth. The other thing is that the speed of the Chinese demographic transition is much greater than the speed, certainly, of the Japanese demographic transition. We're, I think, going to see over the next decade a kind of an acceleration of the negative impacts of demographics. Second point would be, potential growth is one thing and getting potential growth is another, and that is really, I think if China does everything right in terms of the structural reform agenda that's been outlined, we could have a situation in the early 2020s where China is still growing at close to the 5% mark. That would be a very, very good achievement if they did that. But if they screw up on the reforms, then the outlook could be worse than that.
Well, let's turn then to the reforms. We had a brief discussion this morning about the state-owned enterprises, and I think several of the panelists felt they were the critical sort of blocking point that the government has to deal with. Would you give us a little bit of your view about the third plenum's 2013 goals, and then to what extent do you think China can actually achieve those goals?
Well, so broadly speaking, the third plenum agenda, so this refers to the reform sort of blueprint or document that came out 3 years ago, 2013, had a very long list of things, and it was certainly interpreted by people like me and many others at the time as a very positive document that focused on most of the right structural issues. However, there are, I think, two issues. One is that if you look at the structure of the document itself, it contains a pretty glaring contradiction, which is that it insists that market forces should have a so-called decisive role in resource allocation. So that sounds like a very positive, efficiency-oriented view. It also reaffirms the dominant role of the state in the economy. And I think that those two objectives are incompatible. You cannot have both, a decisive market role and a dominant state sector whose dominance is guaranteed. And if we look at how things have played out over the last 3 years, I think what we've seen is that the struggle between the control agenda, which is embodied in this addiction to state enterprises, and the growth or efficiency agenda, that contest has been very severe, and for the most part, the control agenda has won out. And you see this particularly in the state-owned enterprise reform agenda, which at the time of the third plenum, a lot of very interesting ideas were being circulated about mixed ownership, which meant bringing in private shareholders, separating out commercial from non-commercial SOEs. There seemed very clearly a lot of people in local governments at the provincial level were picking up signals that they were being essentially told to set up a lot of their companies for privatization, even though that word was not used. So you got the sense that there was a lot going on, and it was very progressive. And basically that has all vanished. Mixed ownership has now been turned on its head, and what the government is emphasizing is that state firms should invest in or take over private companies because private companies have more efficiency and technology, and so obviously if state companies take them over, they will be able to take advantage of these things. All of the sort of hints at some kind of a staged privatization have gone away, and the emphasis has been on making the central level SOEs bigger through agglomeration and mergers and acquisition, again on the theory that bigger is always better, not more efficient is more better. So I have to say that I'm not, there are a couple of other areas where I think there has been real progress on the third plenum reforms, so it's not all a bad picture, but on that sort of central issue of the ownership of the economy, there seems to have been a clear retreat to a much, much more conservative, control-oriented, state-oriented view, and that, to me, is not a positive development.
Now, extending the line of thought about control, how serious do you think the recent decision to tighten up on foreign exchange transactions is, and do you think it's going to be indicative of other moves by the government?
Yeah, well, that's, I think, quite interesting. So this requires a little bit of history. So in the beginning of 2015, we had a big stock market boom in China. And we also started to see at that point pretty significant capital outflows from China, partly as a result of regulatory changes that made it easier to take money out, and partly as a result of a change in the perceptions of the long-term trajectory of the renminbi dollar exchange rate, which made a lot of Chinese corporate think that the dollar was going to go up, the renminbi was going to go down, and so they would have to start accumulating U.S. dollar assets and getting rid of U.S. dollar liabilities. And that was okay up to a point, but then what happened was that in the summer, we had the collapse of the stock market, which prompted a massive government intervention to stabilize prices and, basically force SOEs and government agencies to buy up huge amounts of equities in order to keep prices at what the government considered an acceptable level. And then second, what we saw ultimately was a response to the capital outflows, which got very large towards the end of last year, which basically they clamped down pretty significant controls on the ability of individual companies to move short-term money out. So what we saw basically from the middle of 2015 to the first quarter of this year was a resurgence of the control agenda in both of these key markets for the purpose of maintaining sort of financial stability. And that's kind of understandable. But what you're alluding to now is that since about April or so, the problem of capital outflows has not been so great. But despite that, we've seen a recent move to significantly tighten the rules on outbound direct investment. And previously, as long as your outbound investment was less than $50 million, all you had to do was notify the foreign exchange authorities that you were going to do this. There was no approval required. That ceiling has now been lowered to $5 million. So above $5 million deal, you have to get approval from the foreign exchange authorities. And what this means is that it is much easier in principle for the government to cut off these flows if they want to. I think what's going on there is, I think this is mainly preemptive. In other words, I don't think that there's a lot of hidden capital outflows that we're not seeing and the government is responding to them. I think they're saying, we foresee that there could be more capital outflows in the future because of this strong dollar that I alluded to. And so we want to be able to be ahead of the game, and if we start to see capital outflows increase, we need to be able to shut the door so that we can stabilize our exchange rate. And I think what this tells us is that when the Chinese leadership of the moment faces a choice between maintaining a stable exchange rate and stable pricing of money on the one hand, or opening up the capital account to allow greater flows and ultimately greater efficiency in capital allocation, if they have to choose between those two things, they will pick stability. So they will pick stability and control over efficiency and growth. So that gets back to what I was saying before.
Okay. A last question before we turn things open to the floor. Would you comment on how you see current policy being affected by the maneuvering before next year's changes in the Standing Committee?
Yeah, it's enormously important. The politics now, I think, are totally dominant, and economic policy is subjugated. Basically, what's going on is that next fall, October, November, there will be the 19th Party Congress. This happens every 5 years. And this is when the seats on the Politburo and the Politburo Standing Committee are redistributed, and old leaders have to step down. On current norms of retirement ages and term limits, the only members of the Standing Committee that can stay are Xi Jinping and his Premier Li Keqiang. The other 5 members of the Standing Committee will have to retire in about 2/3 of the Central Committee. This is a big opportunity for Xi Jinping to fully consolidate his power, get all of his people in all of the key positions. So it is a very, very high stakes thing for him. And there's been a lot of speculation that he will also try to set up a pathway whereby he can stay in office, at least the office of the General Secretary of the Communist Party, beyond 2022, when current norms would require him to step down. So there's a lot on the line for him. This is really crucial. And so from the standpoint of Xi Jinping and his close team, the objective of economic policy should be to make sure that nothing bad happens between now and then, because that would weaken him. So economic growth has to stay at the current level of around 6.5%. If more government spending, if more debt is required to achieve that, fine. Structural reforms that could be good in the long run, but growth negative in the short term, don't do them. So basically, unless there's some kind of really extraordinary thing that comes out of the U.S., like we initiate a trade war or something like that, my case would be that the macro situation in China would be very boring over the next year. Stable growth and not much in terms of structural reform. And the big question is, okay, after the Party Congress, once Xi presumably has consolidated his control, what happens? Do we have a pivot, as some people argue, to a more technocratic economic agenda that really tries to fix some of these problems of increased leverage and state enterprise inefficiency? That would be the optimistic view. Or do we have just a continuation of the control agenda that says, okay, we won, we've been successful, and the name of the game is just centralizing control of the party over everything in society and centralizing Xi's control over the party? And again, I don't think we know the answer to that question. But basically what it means is that most efficiency-friendly policies are pretty much on ice, at least until the end of next year.
Okay, thanks very much. Let's go to general questions.